Thank you for inviting me. I love coming back to Columbia. When I was in academia, Columbia was the place that invited me the most. It got to a point where my wife started getting suspicious. You're going to New York again to present at Columbia, didn't you do this last month? And so this one trip in particular was difficult because I said, well, I'm going to present at Columbia again. And she said, you're not in academia anymore. That does not sound right. And so I said, well, this one is going to be for the benefit of Uniswap LPs. So after that, she helped me pack my bags. That's a good excuse. So I need to warn you that the title of this, What Can We Learn from TradFi, is clickbait. Peter asked me to provide the title ahead of time, and I thought, well, this is a topic that I can probably say something about, and this is a topic that will make people wake up at 9 a.m. But at the time when I committed to this topic, I didn't have anything in mind. 2 weeks later, still nothing. So instead of some specific lessons today, I will just say a few things, and I will just walk through maybe 6 points or so on the intersection of DeFi and TradFi that I think people should be aware of. I'm not going to break any new ground. This is just something that I think is nice to know for DeFi people about TradFi and for TradFi people about DeFi. So first, I could never pull it off when I was teaching. Let's have a quick poll. How much do you think it costs retail investors to trade stocks on their phones, let's say? So think about an app like Robinhood. Let's say that we are talking about S&P 500 stocks, so something that is pretty liquid. But I want you to include all costs, everything. Adverse selection, the fact that the broker will have to, that the market maker will have to pay the broker for your order flow, the fact that the market maker has some risk, everything included. How much do you think this will cost? So raise your hands if you think that it's going to be about 1% or above. 1%. Okay, keep your hands up for the time being. 0.5%. 10 basis points. 1 basis point. All right, okay. So the answer to this is, I don't know. But we have some information on this. So the information I have comes from the best source, from the Feds, from the SEC. So this is from the Securities and Exchange Commission or the competition rule. They have to prepare this analysis. And there are a bunch of lines here. So the ones that I want you to, oh, sorry, I don't see. All right, so now I can trace it.
Use the mouse too.
Okay, yeah. So the numbers that I want you to pay attention to, that depends really on how you measure trading costs, right? So some people might say that let's look at the effective spread. And so WH is wholesalers. So think about Citadel Securities when it fills an order on Robinhood. And EX is exchanges, right, when it goes directly to exchanges. So you see that for S&P 500 stocks, the spread, the effective spread for wholesalers is going to be 0.7 of a basis point. What I think is also more interesting is that you can look at the realized spread. And the realized spread is 0.3 of a basis point. So the realized spread is essentially the difference between the execution price and the markout price, the mid price on exchanges sometime later, right? So basically, this is how much you regret your trade, essentially. You traded something, we calculated the execution price, and then we looked at the mid price on exchange 5 minutes later, for example. And you look at the difference between the two, and it just costs 0.3 of a basis point. And that's the total margin that the market maker makes on this. Remember that people talk a lot about the payment for order flow, so the market maker will have to pay something back to the broker. If you exclude that component from the 0.3 of a basis point, you are left with 0.17 of a basis point. That's the profit that the market maker makes on these trades. And this is not the data from people who love payment from order flow. This is the data from the SEC where they suggest some improvements to this. So what I want to say with all of this is that the trading costs are really, really low. To provide some additional reference points, let's compare it to something. So how low is that number really? Let's look at credit card transactions. How much would it cost you to charge a credit card, a retailer? It's going to be around 3%. And here you might say, well, Alexander, that's not a fair comparison, because out of that, some amount is going to be cash back, and there is also some amount of credit risk involved in this. So maybe let's look at debit cards. Debit cards pricing varies, so you can find different providers, but it's going to be somewhere in the range from 1% to 2%. The amount of cash back on debit cards is not super significant, and also the amount of credit risk is probably not that significant, so we're getting closer to a fair comparison here. But the best thing that I can provide here is just look at the conversion between euro and USD that you can get from payment processors. So think about the market leader. I'm not going to name it, but they were wise enough to enter this market. So they charge 45 basis points for this transaction. And to be perfectly clear about what they're doing, I transfer my USD to them. So they hold the USD in their checking account already. I want euros from them. They have the euros in their checking account. So the transaction that I'm talking about here is just this very simple transaction that I click something on my phone, no money really changes hands at that stage, right? So there is no credit risk. They already hold my cash. Nothing else. There is no cashback, nothing. But that's going to cost you, that simple transaction is going to cost you 45 basis points. This is an order of magnitude, or 2 orders of magnitude, higher than what it costs people to trade on exchanges in the US. So my first point that I want to make is that some areas of traditional finance are really super efficient. And it is going to be very, very difficult to compete with these areas of TradFi. So we perhaps, I know that we want to replace TradFi. We have better solutions. Then we like to talk about the inefficiencies there, but we also have to recognize that the inefficiencies are not uniform. So remember the saying by JFK, slightly modified. If you still want to be in this business, it's fine, but do not sort of think that it's going to be easy. It's going to be pretty difficult. So some areas are pretty efficient. An unrelated point, but since we were on this slide, I decided that I might as well make it. Looking at TradFi data is also useful just to generally, when you have any conversations about DeFi as well. So what is the big scandal in this paper that nobody is talking about? What is the big thing in this particular exhibit? I think it's this line here. Look at how much money exchange makers, the people who provide liquidity to exchanges, how much money they make on these retail orders. And you see negative numbers everywhere. So makers lose money on exchanges. Why is this a big scandal? It's not a big scandal, really. But if you had something like this in DeFi, you wouldn't hear the end of it from the Twitter crowd. LPs lose money. How terrible. Well, liquidity providers on exchanges lose money as well. There are reasons for this, of course. So again, I said that the title is clickbait. I'm not going to be doing this over and over again, but the reason for this is that these people who are losing money on exchanges, they're not necessarily market makers. They're not in the business of trading back and forth. There are also people who just need to trade, and they trade by providing liquidity to exchanges. So think about AQR. They have some longer lasting alpha than maybe 5 minutes out, right? And so they want to trade. They want to get in and out of a position. They will not be makers on an exchange. They will be doing this with limit orders. So they are in this group of people who are losing money, who are earning negative spreads on these retail orders. And so the point that I want to make here, this is going to be my second point already, is that it might be okay for LPs to lose money, or at least not make money consistently in all pairs, if they're getting something in return. And what can they get in return? Directional execution. So for example, when we think about the 5 BPS Uniswap pair, people will be losing more money there than in the 30 bips Uniswap pair or than in a Uniswap V2 pair. But you can get directional execution out of that pair. So maybe that's okay. There's some people might be doing that because they just want to convert from one token to another, and they might be happy to pay for it a little bit. That might be cheaper for them than go to an exchange and be a taker of liquidity. So that's my second point. For my third point, I want to talk a little bit about why these areas of TradFi that I mentioned are so efficient as I showed you earlier. So why does payment for order flow work so well? Well, if you think about trading, the main thing you need to know is that the main cost of trading is adverse selection by far. There is nothing else that is a significant cost, but adverse selection is a really big one. And traders who trade on their phones, they don't enjoy particularly high latency. They're probably not super informed, because if they were informed and they wanted to beat the market maker, they would probably go for a solution where they would have the latency that is necessary for that. So we know that, generally speaking, they are uninformed. One other piece of information that we have about them that tells us they're probably uninformed and they just really want to trade is that majority of their orders are market orders. Market orders. If you really feel that you have some alpha, you shouldn't be really trading with market orders necessarily right away, and particularly if the market orders are slow, right? So they're happy to pay for taking the liquidity, and market makers are happy to provide that liquidity to them as long as they don't face adverse selection from other market makers, as long as they don't have that winner's curse that they would have if they had to compete for each order with Citadel. So for example, if Citadel had to compete with Virtue for every order, the issue would be that when they lose, they know that they lose not to some uninformed trade on Robinhood, but they know that they lose to a different market maker. And so that's a pretty bad signal. I'm saying when they lose. When you win an order as compared to a different market maker. So somebody else didn't want to take it, and that's a bad sign. But the key thing in all of this, the reason why payment for order flow works, is that there are very significant regulatory protection for what market makers may and may not do with the orders. So if you want to look a little bit more closely into all of this, you will see that there are rules, and then there are rules over the rules, and so on and so forth. What are the big ones? So the big ones are, the big three is that brokers and market makers, they will have the best execution obligation to the trader. So they have to be relatively diligent in providing best execution. They cannot trade ahead. They cannot front-run trades. Legally, they cannot do that. But it's not the full story. They also have to have internal controls that would prevent them from doing that, even if some rogue employee wanted to do it. And those internal controls will need to be constantly tested. And there will be supervision from self-regulating organizations, from SROs such as FINRA. So there is a lot of oversight in all of this. If you read indictments, so when things don't go well, how do those indictments usually look? And I'm giving you just one example here. US regulator here finds Citadel Securities over trading breach. The title sounds horrible. Market maker traded ahead of customer over the counter orders for over a 2-year period. But now let's look at what actually happened here. Were they really abusing their customers a lot? Over a 2-year period, the market maker removed hundreds of thousands of large OTC orders from its automated processes, according to FINRA. So what happened there is that they have a very large order coming in, and they don't want to execute it right away. They want to check the details of that order with the customer. There's maybe just some fat finger thing that the customer doesn't really want to have executed. So they put it in a holding tank. And then, that's Citadel Securities, so they trade a lot. So they just make markets everywhere anyway, in all the securities that are out there. So they keep trading. When they get a confirmation from the customer, they proceed with the order. The issue here was that the holding tank, the temporary holding tank for those orders, was not below the Chinese information wall that they implemented. So they assume that they have good internal controls because they separate the execution part of the business from the market making part of the business. But then there were these orders in the holding tank, and they were asked, hey, these orders in the holding tanks, are they really isolated from your market making operation? The answer to this was not really. There was no evidence that market makers use that information to actually front-run the orders. There was just a failure of internal controls. So that thing was settled. And again, the message that I want to convey here is that market makers do not necessarily have any incentives to front-run those retail orders. They're perfectly happy making 0.17 of a basis point on a high volume and just enjoying that, rather than actually trading against those tiny little orders and going to prison for this. So regulation is absolutely essential for the success of the payment of order flow systems in TradFi. And the reason I want to mention it here in this crowd is because in DeFi, you hear a lot about payment for order flow. Let's sell order flow, let's buy order flow, and it's going to be super efficient. Yes, well, it is super efficient in TradFi. But the problem is that in DeFi, we really don't have any of those regulatory protections. So it may not work as well. Or maybe it will, we don't know. So for that, let's move on to my next point. What is the state of adverse selection in DeFi? And of course, you all hear the news, and you know that people get sandwiched, and then sandwichers get sandwiched, and so on and so forth. So we hear all of that. But I will look at a relatively nice area in DeFi where everyone is trying to behave nicely. So let's look at top arbitrage firms, top CEX-DEX arbitrageurs. They generally do not sandwich you. Many of them have their own builders, and they could sandwich you, and they could make money with that, but they try not to do it. They try not to collude with each other. They compete with each other. So that's generally a pretty nice part of the market. But the issue is that block space is competitive. They have to compete for block space. If you don't build blocks in the optimal way, you will not land your transactions, and then all of your customers will not get execution. And who wants to get no execution? When you want to trade, you want to trade. So they're forced to compete for block space, and so they're forced to make certain decisions. I did a very simple experiment here. By the way, I forgot to say, I'm using some legal terms here. I'm not a lawyer. There's no legal advice, no financial advice here. When I show you some data, it was probably prepared by an intoxicated intern on faulty equipment. So do your own research, but I will show you what I have. I did a very simple experiment. I identified top arbitrageurs. So that's step number one. Then I identified transactions from known routers. The routers, people who trade through routers, they're usually not arbitraging really, so they're just people making their own little swaps. Then for those uninformed swaps, so I only looked at uninformed swaps that were in the same block with an arbitrage swap. So I basically just looking at the blocks where you have an arbitrage swap and you have an uninformed swap. And then for uninformed swaps in those blocks, I separated them into 4 categories, like a little 2x2 matrix, based on 2 things. Is the uninformed swap in a consistent direction with the arbitrage swap? So the arbitrage swap is buying ETH. Is the uninformed swap buying ETH as well? That will, if the swap is buying also, I will call it consistent direction with the arbitrage swap. And then the second thing, is it going ahead of the arbitrage swap, or is it going behind it? So if you think about the best way to build blocks, and if you are an arbitrager, you don't want any uninformed swaps in a consistent direction to go ahead of you. You want all of the swaps in the consistent direction to go behind you. On the other hand, if somebody is trading in an inconsistent direction, you want all of them to go ahead of you so that you can backrun those swaps. So let's see what we have in the data. This is the breakdown by transaction numbers. You see that the before consistent group is very, very small, 4%. If you're trading in a direction consistent with arbitrage, you're probably not going to be ahead of the arbitrager in that block. Generally speaking, the consistent transactions, you have about 43% here. They have a lower probability of landing in the same block as the arbitrage transaction. They get excluded, essentially, many of them. The inconsistent transactions are more common. And you also see that they are way more often appear ahead of the arbitrage transaction. Now, that's just the information about transaction numbers, but you can also look at execution quality. What is the execution quality? The best place to be in is ahead of the arbitrage swap and trade in a consistent direction with arbitrage swap. So this guy here, so you see that the cost is negative. You actually would be making 3.2 basis points if you ended up in this group. The problem is that, well, the chance of you ending up in that group is not so high. You can be after an arbitrage swap and trade in a consistent direction, and that's still a good position to be in, because arbitragers actually leave a little bit of money on the table. And so if you look at the mark out on these transactions, you get still you get to make still like a quarter of a basis point. So I need to mention that these are sort of median returns. I didn't want things to be biased too much by large transactions, large uninformed transactions. If you're trading before in an inconsistent direction, you pay a lot. If you generally trade in an inconsistent direction, you pay a lot. But then if you go before and trade in an inconsistent direction, you pay 16.2 basis points. So as you can see, something like this would not necessarily fly in traditional finance. But also, again, if you are not building blocks that way, you're not going to land anywhere on the blockchain. So you sort of have to do it. And there are indications, again, that arbitragers are really playing nice. So for example, as you see the transactions that are in the inconsistent directions, they are not all here. So they could have put all of their transactions before their swap, but they're not doing that. So there's some ray of light here. When I showed a variant of this data to CMAC, he said, well, this is really interesting. Who is in this before consistent group? How does it happen that an an uninformed person trading through the router is trading ahead of the arbitrage transaction in the same direction and making this profit? So I thought, well, that's really very interesting. So let's take a look. So I just found a bunch of transactions that made the highest profit. And so this is one of them. Just let's look at the transaction impact here. So what is they doing? They're trading ETH, they're trading USDC for ETH, and then they're trading ETH for Link, USDC for Link, USDC for ETH, and then ETH for Link, USDC for Link. So essentially that's a trade of USDC for Link, but sometimes they go through ETH. And so in this particular pair, USDC to ETH, you see there was a significant transaction to 70K. That was pretty profitable, because that was generally a good idea to trade like that in that block. So how did it happen that this transaction by an uninformed trader ended up ahead of the arbitrage transaction here? So let's look at the top of the block. This is the top of the block. This is the transaction that we are talking about. And you see that it got sandwiched by Jared from Subway. What exactly does it mean that it got sandwiched by Jared from Subway? Well, it means this. Jared from Subway, in the first transaction, is trading in the same direction, ETH for Link, and then he is also adding a lot of liquidity into the Link ETH pool. So basically, he's doing two things at once: a sandwich, trading ahead of the transaction in the same direction, and then he will follow up by trading in the opposite direction. And also, he's providing JIT liquidity. So it's a combination of JIT and sandwich. And what happened in this case is that the transaction made 4.4K in markouts on this good ETH USDC trade. But since it got JIT plus sandwiched on the general link trade, it actually lost 6.5K on that other leg. So if you really want to end up in this group of transactions, the recipe is simple. You just have to be abused by a high amount somewhere else. Then you will get sandwiched by Jared, and Jared will ensure priority. So adverse selection in DeFi is almost inevitable, unfortunately. And by the way, when people criticize regulators, so I so far only said good things about regulators. But when people criticize regulators, the usual critique is that they're worried too much about price. You have to provide the best price. You have to provide the best execution. What they're completely not worried about is the risk of no execution, of non-execution. Sometimes there is a trade-off. You get better price, but you actually get to trade in the direction that you like. Or maybe you don't get a price that is as good, but then your trade actually goes through. In DeFi, this trade-off is very, very prominent. You have to choose one of the two. If you were to choose good execution, if you were to force it, then, well, go ahead, but your transactions will never land, and you will never trade in the direction that you want to trade. Because block builders have to compete for that block space. All right, so am I out of time already, or? Yeah, okay. I just have two more thoughts, so I'll be quick here. Can DeFi ideas be useful in traditional finance? Because sometimes I hear that, well, you're playing all those AMM games, but they will never be useful in DeFi. And so I feel like the ideas that we're developing here, they are not just of interest for this particular application that we're looking at, but they might be used more broadly. Let me give you one example. Right now, exchanges try to come up with new order types all the time. So one particular order type that I'm sure you have heard about is called an iceberg order, where you have a part of the order, it gets filled, and then the second part is placed in its place, and so on and so forth. So that's sort of like an automated order that some exchanges have. In theory, exchanges could come up with an order type that would essentially be something like an AMM. So one example that I want to give you here is this exchange called IEX. It is known for the dislike of high-frequency traders. So they slow down, they circuit break all the takers, they slow down the takers. And so one of the innovations, recent innovations, is this delimit order type, discretionary limit order. What they have is that you place a limit order, and it might get filled at that price, which is good, but they slow down taking orders, remember. So the takers are slowed down, and then they have this thing called the signal with a capital S. The abbreviation used to be CQI, the crumbling quotes indicator. So when they feel like there is a lot of pressure that is going to be incoming from takers, they might move your order to a safer place. You will get a fill at a better price based on that signal. So they don't want people to get picked off too quickly. Does this remind you of anything in DeFi? No. Almost sounds like Lifinity to me, for example, right? So you can have a placement of the order that is based on some Oracle information. So here you have a very similar situation, that the protocol itself can move orders if they have some indication that those orders might be picked off. So in theory, what one could build an AMM type order on traditional exchanges. And I really believe that this might happen eventually. But again, one thing that you will probably run into is regulation. And so this is something that eventually people will have to think very carefully about if they want to implement orders like what we know as the AMM on traditional exchanges. In this particular example, you already have people who are not happy about even this simple order. For example, Citadel was complaining that At some point, they might be required to route orders to IEX because they have the best execution requirement. So they are forced to go there for liquidity, but IEX slows them down as the taker, so they will not let them order go right away, and then they move it away from them. This is not good when you're forcing one party to get good execution and go to a particular exchange, but the exchange doesn't actually have to respect the posted price. There is a lot of regulation on this particular, in this particular area. Rule 610 of Reg NMS and then Rule 611. So 611, everybody knows, it's the no trade throw rule that you basically, if an exchange is going to fill an order, but then somewhere else there is a better liquidity, they have to route it this way. 610 is a related rule where an exchange is not allowed to post new liquidity if that new liquidity would cross or lock liquidity on a different exchange. So the issue is that for exchanges, traditional MMs work this way. You take liquidity from this side, we always put it on this side. You take liquidity from this side, we put it on this side. You take from this, we put it on this side. But exchanges often cannot do that. They often cannot put liquidity at a different place. They have to see if somebody else has liquidity in that area, and then they have to route to that exchange. And in fact, that even happens with iceberg orders. So can DeFi ideas be useful in TradFi? I think certainly as an order type, but regulation will be an issue, and regulation will have to catch up. Because again, people in TradFi right now are not happy about some of these rules that are already in place. And then really my last thought, but how much time do I have, Siamak? Am I out of time now?
We started a bit late, so yeah.
Okay, so my last thought, how does DeFi win in all of this? And here I felt like I'm at Columbia, I really need to have some formulas. I want to show you a very underrated result from the finance literature, real quick. So, and I'm not even gonna tell you where I'm going, so you will only know when we arrive there, right? So let's say that you have overlapping generations of investors trading a certain stock that has a payoff of M and some variance of sigma squared, and that's the only risky asset in the economy. And representative investors have constant absolute risk aversion. If you don't know what it is, really, there is an easy way to learn this stuff. Get a PhD in finance here at Columbia. They will teach you that. So you have a constant risk, absolute risk aversion utility function. And the question is this. So the first question, you hold the stock already. What is your utility from holding the stock? It will not be exactly this number because it's exponential and all that, but it's going to be related to this number. You may have heard the term certainty equivalent. So this is what the certainty equivalent is. That's the expected payoff, M, minus rho sigma squared divided by 2. Rho is your risk aversion coefficient. Sigma squared is the variance of the stock. And we know how to divide by 2. So that's the certainty equivalent. And notice the important part in all of this is that you see the impact of risk aversion. For the same mean, the valuation of this, the utility that you derive from holding this stock, is lower if the variance is higher. This is how certainty equivalent works. It makes perfect sense. You're holding a risky asset, you value it less than an asset with the same payoff, but no risk. All right, so we know that. Certainty equivalent. Again, I think that's actually in the CFA program, so you can really trust me with this particular formula, I think. Let's continue. Let's now go a step back. So we calculated the utility from holding the stock, but how much will the stock be traded before, in the market before you buy it? So you have investors trying to buy the stock. What will it be traded at? And the answer to this is also well known. It's M minus rho sigma squared. You can compare it. It may not be obvious right away, but you can compare it to the capital asset pricing model, because in CAPM you would have, here instead of sigma squared, you would have covariance of the payoff with the market payoff. But here we only have one asset, and so one asset is the market. So that covariance becomes variance. So take my word for it. This formula is also well known, M minus rho sigma squared. But now look at what happened. The investor pays this much, M minus rho sigma squared, to get utility of this much, M minus rho sigma squared over 2. So how much utility does the investor derive from getting into the stock? Notice how this question is different from the one that I asked earlier. So before I asked you, how much utility does the investor derive when the investor already holds the stock? That utility is decreasing in sigma squared. But here I'm asking you, before the investor buys into this stock, how much utility will they derive from getting into the position and then getting the payoff? And that is just rho sigma squared over 2. And here's my big question to you. What happened to risk aversion in all of this? We have risk-averse investors. Risk-averse investors. You're not supposed to like risk. But your utility is rho sigma squared over 2 is increasing in risk. So for this, I want to cite this paper, Should We Regulate Financial Information, that talks a lot about this. It's a very similar, very similar setup. They sell it as a disclosure story, a story about disclosing information, but that's the same story that I roughly told you here. The idea is that once you hold the asset, you would like the risk of that asset to be lower. But risk-averse investors really love having access to risky securities. If you think about a world where there are no securities at all for you to trade, except for T-bills, everything is riskless, would that be a fun world to live in? And the answer is no. You would not get much utility from it. You would get exactly what you paid for. But here you can pay for risk, you can choose how much risk you buy, and you can derive utility from it. So I love this sentence here. Investors benefit from access to high-risk, high-return assets. They're indifferent between holding the last marginal share of the risky asset, but earn utility benefit from holding all the inframarginal shares. So I think that this is one of the really important lessons from the finance literature that we should all keep in mind here, is that risk-averse investors actually benefit from having access to risky securities. And this is how DeFi wins. People love to trade. People love to have access to risky securities. And you can provide markets for risky assets. I will not say securities. For risky assets faster than they would otherwise be available. That's a big benefit of DeFi. If you can let people do what they like, namely trade. All right, so these are the 6 things that I mentioned. I'm not going to go over them again. This is my Twitter account. Subscribe for more material like this, or don't subscribe for more material like this. One issue with it is that there are a lot of dead jokes there. So, well, anyway. You are not going to get 17 followers unless you make some dead jokes. So, thank you very much.
Hold on. It's the Stanford zip code. Any questions?
I was going to say I don't know, but yeah.
Yeah.
Oh, okay.
So when you measure the execution quality and where you saw that when you check the markouts, it's positive profits, and then but then when you look at the sandwich and JIT, it's like negative. So is it right to think that basically for the markouts you are comparing with like a fair market price on centralized exchange, and so it's kind of like end of the block price, and when you compare they're losing money from sandwich, it's more like comparing with the last block best price. So it's like just different measurement can change the results a lot.
So this is markouts. This is relative to price on Binance a little bit of time later. The loss on sandwich here, 6.5K that I mentioned, that's a, how you call it, an atomic loss, right? So it doesn't really, it's basically a loss in USDC that was extracted from
compared to what price?
Say it again?
Compared to what price?
It's an atomic thing. So I'm not even sure. So I didn't calculate markouts here. It could be different. So, but the thing is that so basically somebody walk away with 6.5K in USDC from this transaction, and the trader got execution that was less by that. I didn't actually have to mark it to anything because it's in USDC already, and it's atomic. So they should have gotten more by this exact amount. So this is why I didn't do the markout thing, but maybe I should. But USDC was about $1 at the time, so.
Thank you.
Yeah, hold on.
Just a devil's advocate, is measuring the efficiency of TradFi by just looking at the transaction fees that users pay too limiting? Just because, you know, not everybody gets a Robinhood account, you might not get interest on the money. DeFi offers arguably 24/7 real-time global settlement, et cetera, et cetera.
Sure, I agree with you. So that's certainly true. Again, I think this is where DeFi could win as well by providing broader access for people to trade. If you are in North Korea right now, a law-abiding citizen in North Korea. Do I want to go there? But this is being recorded. But if you are a law-abiding citizen in an oppressive regime, you may not be able to get a Robinhood account. So, but don't get me started on the other costs that I didn't include here. So, for example, when I talk about the markouts in this table here, I don't include the cost of gas, which is going to be pretty significant. So, of course, there are some costs that I'm excluding here and there. And, of course, you cannot compare things directly. My first point was that you should not just be like very excited about this. Yeah, we're going to solve the TradFi problems. I mean, those guys also know what they're doing. So a little bit of mutual respect would be.
Yeah.
Thank you. Yeah, great talk. So I'm of the opinion that DeFi should strive to be better than TradFi in many ways possible. I was surprised by the fraction of a basis point that the citadels overall make. So should we strive to lower the pool fees on Uniswap to less than a basis point, perhaps? So is this race to the bottom already something we cannot go below 1 basis point, or is this something that we could also get?
It's a complicated equilibrium, right? So I would not necessarily say that first of all, again, I don't think that the goal should be, if people are happy doing what they're doing and getting execution that they're getting from Uniswap right now, and they seem to be doing good. I mean, people are trading on Uniswap, so maybe you don't want to necessarily change things right away and go to 1 basis point pool in this USDC pair. Besides, there is a pooler with a 1 USDC pool, and yeah. So, but I don't think that necessarily the goal should be competing with DeFi. But I also don't think that with TradFi rather. But I also don't think that the goal should be like inventing some money printing machine where all passive LPs always make money. Yes, again, there are people who are happy to eat a little bit of a loss, but get into the position that they like. So, for example, if you have to trade a massive amount in some direction, wouldn't it be better to do this with an LP position in the ETH-USDC pair, 5 bips? Maybe lose a little bit, but you would have to pay elsewhere for execution. Anyway, so my point is that, don't break things that are not kind of, if things are working, so maybe just marginal changes and see in which direction they go, but it's very different approaches to things, of course.
All right, let's thank the speaker again.
Okay.